ever wondered how you get your money at pension? Well, this video is for you.
Hey guys, and welcome to Manage Your Money. Welcome back guys onto our pension basic series. Sadly, this is our last episode on the series, but if you've been with us from the start, we hope you've been enjoying the journey, learning valuable information on how to plan and enjoy your retirement, and receiving practical tips to work on it as soon as possible. But before we continue, please do subscribe to our channel to support what we're doing, and also be updated with our future videos, all coming up just for you.
Following on from our series, if you haven't watched those videos, please kindly go and watch those videos first so that you can understand in depth as to what we are going to be talking about in this video. So we've given you the figures, we've given you the different ways in which you can invest towards your pension. Let's fast forward, a few years back, quick into the future. How do you take your money out? So, we've talked about the workplace pension, lifetime ISA, and SIPP. With the SIPP and the workplace pension, they act in the same way. So you can take your money out pretty much the same way.
With the lifetime ISA, you can withdraw your money at the age of 60. If you take the money out before that age, you're gonna get that penalty, 25%. You don't want that. So remember, 60, the age of 60, you can withdraw your money from your lifetime ISA for a pension. And the money that you withdraw is tax free. Ain't that wonderful? So that's one of the good benefits of having a lifetime ISA for your pension. And on top of that, don't forget, any withdrawals from your lifetime ISA pension may take a few days for it to be credited into your bank account. So just remember that.
Yes, so it's pretty straightforward, right? So now we come to the SIPP and workplace pension. This is where you need a cup of tea and a pen and paper. At the tender age of 55, you have access to your SIPP pension or your workplace pension. However, most people at that age are still most likely working, and you can just let it grow without taking it out till when you actually retire. So you have even much larger sum rather than taking it out at that age of 55. However, in 2028, the age does go up to 58, but it's okay. With the SIPP and workplace pension, you get 25% of that whole lump sum free. So that means if you watched our previous video, let's say you chose to live the moderate lifestyle and you saved up your £154,000 plus in your pension pot, and you put that through your workplace pension and the SIPP. What happens is that at that time, you can get 25% of that tax-free, yeah? Remember, a few years ago, you got tax relief. Now, this is where the tax shows up, right? So you get 25% of that tax-free, which is very nice. And then 75% of that does get taxed. And you need to think about what methods you want to choose as to taking your money out. You have the option of taking it all as one lump sum, boom, taking that out. You may want to consider, however, that a higher tax rate might be associated with that amount if you take it out as a lump sum, simply because, still following on from the example of the £154,000 plus, that is at a high tax bracket right now. So if you took that money out, you would get your 75% taxed at 45%, and
that's a lot, y'all.
However, there are 2 or 3 other ways in which you can take your money out.
One of the options that you can withdraw your money in retirement is through buying an annuity.
Buying?
Yes, you gotta buy it. Annuity does come at a cost, because what happens is, let's say there's an insurance company that provides you a regular income, and this regular income is it's technically like you being an employee and they are the employer and they pay you. you know, they're providing you that service, so that's why you gotta pay. Different insurance companies do charge different rates, so do check the link that we have in our description box where you can compare the different insurance companies' offers and do your own research. And with that, you know, this is a guaranteed income. So mainly your pension pot, you give it to the insurance company, you agree, you know, what income you want on a yearly basis. They say it, yes, they set that, and you can't change that income amount. So do consider how much you actually want, because once you set that amount is set for the particular fixed terms, or if you want it for the rest of your life. And yeah, so that's one of the benefits of having an annuity, is that, you know, this income that you receive on a yearly basis is guaranteed, so you won't run out of money, which, you know, reduces the stress of, oh, I ain't gonna have enough money. So do think about that.
And because it is income, you do get taxed, right? So let's say you set a high income, that's gonna come with a high tax band, right? If you set a lower income, that's gonna come with the basic tax band. Another option would be the drawdown method. What you would do is you take your pension, the 75%, if you've taken the 25% tax-free, you'd put that 75% into investment, and what you would do is on a monthly basis or a yearly basis, you would draw down a certain amount, let's say 4% of that, and then you would live off that amount. The drawdown method allows you to have a flexible income because you can determine how much you want to take down, and maybe some years you might need more and some years you might need less.
On top of that, the remaining money that's in your pension pot through a drawdown will be invested. So your money will be growing over the years. And that's one of the benefits of having a drawdown. And you have the flexibility of making your own investments. So you can choose to invest in stocks, shares. You can choose to invest, you know, in high risk investments or low risk investments. It's all up to you.
However, you know, still remember that your income that you take will still get taxed. Can't run away from the tax, man. Last and final would be an option where you can mix and match the methods in which you put your pension pot into.
Yeah, so it's like, you know, remember them days, or just probably still do it, mix and match candy. It's something like that, but it's just that you can't eat the money anyway. So yes, mix and match.
You can buy stuff to eat the money.
Hey. So yeah, so with the mix and match option, technically this depends on how many pension pots you do have. So for example, you can have, let's say, pension pot 1 that goes to annuity. So you want 100k to be annuity, and then you decide the amount of income you want to receive every month or every year. With the pension pot 2, if you have it, you can decide, all right, which pension pot 2, I want that to be a drawdown. So therefore, you would have the control and flexibility to choose how much income you want on a monthly, yearly basis. So that's what it is with the mix and match option. So it's quite handy for some people, but again, do your research and see if that option is the best financial decision for your money.
It is important to consider the other forms of income you will have at retirement, because that will impact how much you might want to take and be taxed on when you're at this stage of life. We hope you have enjoyed this video, guys. Let us know in your comments below what you think, what you thought, and how this has helped you, and we'll see you on our next video.
Yeah, take care.